Welcome to this weekly update. I'm Julia Lee, an equities strategist with Bell Direct. Over the last 4 months, we've seen a lot of volatility in terms of the bond proxies, and that's because we've seen a lot of movement in terms of bond prices and bond yields. If we have a look at a 50-year chart of the 30-year Treasury bond yields from 1966 to 2016, you can see that there's two very distinct phases. One where we were seeing yields rising up to 1981 and then yields falling from 1981 to the beginning of 2016. It does look like that we may be at an inflection point for this very long-term trend that's lasted 35 years. And as a consequence, we are seeing a lot of volatility in terms of some of those yield proxy stocks, as well as those high-yielding sectors. If I show you a 1-year chart now of the 30-year Treasury bond yields, you can see what's caused this volatility. It's basically like a V-shape with that inflection point being around about 4 months ago. And of course, since then, we have seen the bond proxy type sectors as well as stocks reacting. And these stocks and sectors tend to move together with bond prices, so in the opposite direction of bond yields. There's a lot of different lines on this chart, including the property, utilities, telecom sectors, Sydney airports, as well as Transurban, all areas which are considered bond proxies. But the key to this graph is that they're all moving in the same way with the inflection point around the same time as well. So look, these stocks are expected to be influenced very much by the direction of bond prices and move opposite in terms of bond yields. A lot of the brokers also focusing in on the impact of the steepening of the bond yield or expectations around more hikes in terms of US interest rates and the impact that it's having on these sectors and stocks. We have a look at Deutsche Bank concentrating on Australian infrastructure, and Deutsche Bank has seen downgrades across this sector this week. We have a look at some of the key ones. Macquarie Atlas down to $4.75, so cutting $1.35 from its target price. Transurban $9.65, cutting 95 cents from the target price, and Sydney Airports at $6.05, cutting $1.55 off the target price. In fact, Deutsche Bank has no buys in that infrastructure space. And if we have a look at why, Deutsche Bank believes that the 10-year Australian bond yields could reach 3% from 2.7% currently. Goldman Sachs also looking at this and saying, look, don't assume that equity prices are simply going to price in the spot bond rates. In fact, the equity markets are even more hawkish. Equity markets pricing in an 80 basis point steepening of the yield curve. And so Goldman Sachs in the medium term is underweight bond proxies, but overweight banks as well as cyclicals. Talking about bond proxies, one of those bond proxies, of course, is Telstra. And Telstra had its investor day this week, and we did see a good share price reaction in terms of that update, as well as in reaction to what was happening to the bond market. It's interesting to see where the brokers stand in terms of a target price for Telstra. Shaw is at the lower end with a $4.65 target, Deutsche Bank with a $4.75 target, Credit Suisse with a $4.80 target, and UBS, one of the most bullish, with a $5 target. Now moving on to Ord Minnett's equity strategy and focusing in on 2017, where Ord expects the Australian economy to grow by 3% and the unemployment rate to be at 5.7%. In terms of the banking sector, it expects modest growth, a total return of around about 15%. Insurance stocks should see some tailwinds from the steepening long end of the yield curve. And if we have a look at the ASX 300 mining index, which is up a massive 48% in the year to date, Ord thinks that it has the legs to continue on in terms of the rally. It also sees upside risk to the earnings per share target for the Australian share market at $354.20 per share. So expect to see some upgrades there. Moving on to Credit Suisse, which is looking at gold, and it sees no positive catalysts on the horizon for gold and sees one of the key drivers being the real bond yield rate. And real bond yields have been rising and are expected to rise even further, which is bad news for gold prices. Also, we're seeing a strong US dollar, which is bad news for gold as well. Moving on to Morgan's and its model portfolios and the changes that it's made in October. Starting off with the income portfolio, where it has trimmed positions in both Macquarie Group as well as Challenger. It's bought a new position in Macquarie Atlas, and it's added to positions in APA as well as Spark Infrastructure. In its balanced portfolio, it's also trimmed its position in Challenger Financial Group, and it's bought into ALS, stock code ALQ. And finally, in its growth portfolio, where it sold RCG after a pretty good run, locking in some profits, and it's trimmed PWH, as well as adding RWC, Star, as well as Smart Group SIQ to its portfolio, and adding to those positions in its portfolio. No changes though in the property space. So altogether, a lot of the brokers focusing in on what's happening in terms of the bond markets, and it looks like a lot of brokers cautious in terms of some of those bond proxy areas. I'm Julia Lee, an equity strategist from Bell Direct. Have a great weekend and hope to see you next week.